Bloom Energy was trading above 320 just a month ago. Today it's hovering near 185. Morningstar actually raised their fair value estimate on BE by 15% this month, citing long-term AI data center demand. So why did the price fall almost 40%? We ran the 1-month hourly FSR to audit the data structure. The fundamental narrative around Bloom Energy is a tug of war. On the bullish side, tech giants need stationary fuel cells fast to power massive AI data centers. Deals with partners like Oracle and Brookfield reflect multi-gigawatt opportunities. Morningstar bumped their valuation model, and Wall Street maintains an average target far above current trading levels. But on the bearish side, recent regulatory delays on natural gas pipelines and short seller accounting scrutinies have injected major friction into execution timelines. When AI capex expectations are high, any delay gets punished aggressively by the market. Looking at the 1-month, 1-hour interval chart, overall FSR score comes in at 76%. The red dash line marks the 1-month average price, right at 250. Notice how the stock held above 300 early in the month. They cross-penetrated the 250 line around window 60. The sliding window rolling FSR tells a real story, averaging 93% but swinging wildly between 87 and 99. Every time the rolling predictability topped out at 98, 99, it was followed by a structural leg down. Right now at window 141, price sits near 185, while rolling FSR is hovering around 92%. This chart is a textbook example of macro sector repricing, combined with headline volatility across the entire AI-powered and clean tech space, from Vertiv to Plug Power and Oklo. Valuations are being squeezed as investors demand proof of immediate delivery rather than multi-year promises. Bloom Energy has the order backlog, but until regulatory hurdles clear, the price is trading well below its 1-month average. All this data can be run at predictability-api.com. Link is in the description. Thanks for stopping by. We'll catch you in the next one.